Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. In my last episode, I was talking about all the important financial terms that you needed to know to understand the financial jargon. I talked about present value, future value, and all the things related to moving money in time, as well as bonds or stocks. So now that you know what all of these concepts mean, I'm going to start this episode by actually moving money in time, and I'm going to show you the two equations that show the value of money. These are going to be the compounding equation, where you move money into the future, or the discounting equation, where you're bringing money from the future into the past. For all of these equations, you're going to need 5 elements: the future value, the present value, the interest rate, the compounding frequency, and the time period. All of these are going to be given except for usually one, which is the one that you have to find. So let's start looking closely at each of the formulas, and I'll give some examples so they start making a little bit more sense. Let's start with the compounding one, and this is where you're going to take present value into the future value of the money. Compounding starts with the present value, and you multiply that for 1 plus the interest rate, and then you're going to close that parenthesis, and all of that you're going to put it to the power of the periods that you're going to get it. So let's put all of this with a specific example. Let's assume I have a bank account that's going to give me 5% interest for 5 years, and I want to deposit $100 on that account. So if I start with $100 in my account, I'm going to multiply that value for 1 plus 5%, which in theory would be 1.05, and then I'm going to close that parenthesis and elevate it to the power of 5, because I'm going to keep the money in there for 5 years. What I'm going to get as a result is the money that I would get in the future. And if you want to try it out, you can share your responses in the comments, and I'll help you know if you're doing the process correctly. I'll also share the equations in the comments so you can see them and not only hear me saying them. The second equation is going to be extremely similar, but we're not going to multiply the interest rate, we're going to divide it. Because this time we are discounting, we're bringing money that was in the future into a present tense value. So, discounting will start with the future value that you have, and we're going to divide that future value in 1 plus the interest rate, and then we're going to add that 1 point something that you have to the power of the amount of periods that you're discounting. All of this will give you the present value equation. And so, how can we see these equations relating to each other? Well, basically, I told you, all of them have the same components. They all have interest rate, they all have time, they all have present value and future value. But how are we going to know the relationship between them? In the first equation, compounding, when the rates go up, so you have a higher interest rate, your present value will also go up. Because it's simple. You have more interest, your money will grow more. In the first equation also, if you have more time, your present value will also grow more, because you're leaving this interest compounding for a longer period of time. And then the third factor, if you have a higher future value, of course you'll have a higher present value, because these two are correlated. You have more money today, you'll have more money in the future. But these relationships might switch a little bit when we bring them back from the future to the past. And why is that? Because if you have a higher interest rate, then your present value will decrease because you are discounting to a higher interest rate. And this means that you are dividing this interest rate, not multiplying it. So if it's a bigger value, your present cash will decrease. If you have higher time, this will also make the value smaller, again, because you're dividing it. But the relationship that stays the same is that higher present value will lead to higher future value. So this is how all the elements of this equation are correlating. And so if you want to determine the price of the asset, basically you'll need three important factors. First, the cash flow, also known as the present value or the future value. And we have to understand, I'll do a small recap from my last episode, that the future value is the equivalent value of a current cash flow, but in the future. And we also have to know this is the expected cash flow. It's not that you'll actually get it, it's the one that you're expecting. While the present value is the value or the cost benefit today. So that's the first element that you'll need. The second element is the interest rate. And the interest rate, I was talking in my previous episode, is the one that captures the risk of the asset. This one will connect the risk and the price, because R is going to measure the return. Different assets will have different interest rates, and this will be mostly due because everything has different levels of risk. And so you can think of R maybe as an exchange rate. I am exchanging money for today for money in the future for a specific number. There's an important saying in finance, and it's probably related to interest rates, that says, you can sleep well or eat well. If you sleep well, it means that you have low risk. But when you have low risk, you also have lower discount rates or interest rates. When you eat well, you're not sleeping well because you're very stressed out that it's a risky asset, but that's giving you higher returns. If you have high risk, you'll also get a higher reward, but if you have lower risk, you'll get a lower reward. It's going to be part of the financial industry, so you can either sleep well or eat well. Then the third factor that it's necessary is time, because compounding frequency will change, and this can be either monthly, daily, quarterly, you say it, thusly. The higher frequency will end up always giving you more money, because interest, as I said on my last episode, will start earning interest on itself. This means if you have $100 invested and you'll get interest at the end of the year, that will give you less than if you had $100 and you had that same interest rate, but compounded monthly or daily, or even semi-annually would give you a small amount more than if you only have compounded at the end of the year. So this is just a life hack. Try to get things that are compounded more frequently, as this will give you more return on your assets. So because of this, basically summarizing it up, higher initial investment, higher interest rate, or higher time horizon will be the three ways to push the present value of an asset up. And so, how to get a high percentage of return when you are analyzing a project? Well, there are basically three ways to get a high percentage of return. First one is to take more risk. The second one is to exploit mispricing. 2 episodes ago, I was talking about not only looking at the financial health of a company, but looking how it's overpriced or underpriced. If you see that there's some mispricing in the market, you should exploit it, because that's going to be the only other way of getting a high return. And the third one, which is one that's not very admitted, it's luck. Only those 3 things will give you a higher return: higher risk, exploiting mispricing, or luck. Now, when we're talking about valuing a project, we're going to get 2 options for doing this. And these are 2 options that I already started discussing in my last episode, but they're going to be NPV, net present value, and the IRR, which is the internal rate of return. So let's start with NPV. NPV, I told you it's the value created. And this one will be all the forecast of revenues and expenses but brought to present value. So we can compare all of those values. And this measure will always be the best one for comparing two projects. If NPV is higher than 0, you should go ahead and take that project. Because if it's higher than 0, it means that you are creating value. If it's negative, then you shouldn't go to that project because you're not going to create value, but you're going to destroy value. If you have two projects that both have a positive NPV, then you should always go for the one with the highest NPV. So this rule is very simple. High NPV, go for it. Low, don't do it. The other way of valuing a project is the IRR. As I was telling you, this is the return that was generated by the investment. And basically with the IRR, you already have all the cash flows. The thing is that you're finding the interest rate or like the return that was generated through that project. But for comparing this one, it doesn't necessarily have to be positive or negative. The thing is that we should compare it with the discount rate. So if the IRR is higher than the discount rate, you should go ahead. This project is creating more value, giving you more return that you would get with a discount rate. But if the IRR is lower than the discount rate, then you shouldn't take this project because the discount rate or some other option will giving you more profit and will be creating more value. The IRR that's lower than the discount rate would be unattractive. So when comparing different projects, the IRR will give you a different number, but ultimately NPV wins. This is what you have to have in mind. If you're using these two variables, know that the priming one will always be NPV. Finally, I want to finish this episode by talking about situations when you get multiple interest rates. For example, let's imagine a place that's managing pension funds and they want to invest a little bit in stocks and a little bit in bonds. Stocks are going to give you a higher rate because they have more risk, whereas bonds are going to give you a lower rate because they're probably one of the safest assets that you could get. So when you have two different interest rates, how can you compare them? How can you start knowing how much you will have for your pension if you have two different interest rates? Should you just take 0.5 of the stock's interest rate and multiply it times 0.5 the bond's interest rate? That may give you an NPV and a pension that's fixed, but every situation will change. And when it comes to pensions, for example, we should use the lowest rate because this one is the only one that will have guaranteed. If cash flow is guaranteed, we should also use a safe guaranteed rate. So we should do the entire calculation based on the bonds rate, even if you're also doing stocks, just because this is going to hold a different level of risk. So the sad thing about this that I'm saying is that when you have multiple interest rates, you can't generalize a formula to use. You have to analyze each situation to know if you can either add up the interest rates, multiply them, or you have to use either one or the other. In my specific example of pension funds, you should use the lower one. Because if you use a higher discount rate, you might be masking the problem. And you might be saying a project is good or profitable when it's actually not profitable or it won't have returned earnings that you're expecting. On my next episode, I'm going to start talking about how to calculate the value of bonds and stocks with the equations from annuities and perpetuities. So I'll see you then so you can learn about them.